if you have that philosophy that the markets are always going to be smarter than any individual investor. And this idea that markets will always be priced to reward investors. The combination of those two ideas is super powerful and freeing. Markets reward investors over the long run. I strongly believe that markets do a great job of getting information into prices so that you should expect a positive expected return every single day, every single moment that the market is open.
Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Marlena Lee, Global Head of Investment Solutions at Dimensional Fund Advisors. She studied and worked alongside Nobel laureate Eugene Fama while earning her PhD at the University of Chicago Booth School of Business.
Bear markets, down markets, they will happen. There's different ways that you can plan and prepare. Financial plans shouldn't be set and forget. Process of updating the plan where it's, hey, if things get tough for longer, then maybe we need to save more, or maybe we need to cut back on spending. Those are the things that are under our control. So the only thing we can really do is plan for it.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Marlena Lee, Global Head of Investment Solutions at Dimensional Fund Advisors. Marlena leads a 70-person team that sits at the intersection of investment research and client education, helping advisors and institutions make sense of markets, factor investing, and long-term portfolio construction. Before stepping into her current role, Marlena co-led Dimensional's research team and helped set the firm's global research agenda. And going even further back, she studied and worked alongside none other than Nobel laureate Eugene Fama while earning her PhD at the University of Chicago Booth School of Business. Marlena has a deep understanding of academic finance, but what really stands out is her ability to make those concepts clear, practical, and relevant for investors today. In this episode, we'll talk about what it is to be learning from Eugene Fama, why investors struggle with uncertainty, and how to think more clearly about diversification fads and the role of value in a long-term portfolio. Marlena, it's absolutely amazing to have you on the show. Welcome to The Blunt Dollar.
Thanks. I'm super excited to be here.
So before we get things going, maybe a very quick ad. The reason why Marlena and I are talking today is because the CFA Institute very kindly made an introduction. Why? Well, because both of us are going to be at the CFA Institute Live 2025 Chicago conference. It's taking place from the 4th till the 7th of May. There's going to be over 2,000 investment professionals talking about some of the major topics shaping finance today. Marlena is going to be there. I am going to be there. And many, many other people are going to be there. So if you're into finance, into markets, into networking, make sure to attend. This is going to be one of the coolest events within finance this year. You can check out all the information and the agenda on the CFA Institute's website. And you will also see that Marlena is going to be participating in a panel discussion called Data Mastery, Crafting Investment Stories from Big Data. I'm very, very excited about that one. I'll make sure to attend. So again, go and please check out the CFA Institute Live website. It's going to be absolutely a blast. So Marlena, now that we have that out of the way, let's get things started. And please tell us, what is it that you do exactly today? Give us a little bit of an introduction of your role at Dimensional.
Yeah, sounds good. So I run a team called Investment Solutions. As you kind of mentioned, I came out of the research side of Dimensional. And what I was finding then was, research at Dimensional is pretty in-depth. The research is done when it's done. We want to make sure that we don't leave any stones unturned. And that means it sometimes can be a pretty lengthy process.
Mhm.
And just the speed at which people consume information these days, right? It's so much faster, it's more bite sized. And I think that there was a need for something to sit more in the middle of, yes, let's still be true to all of the rigor that we have in our investments. A lot of it requires a lot of technical expertise, a lot of deep dive, a lot of details. But how can we elevate that so it can reach a broader audience? How do we make sure that we are meeting our clients, like regardless of their level of technical expertise, where they want to consume information about us? Some of that might be analytics, some of it might be content pieces, some of it might be a conversation. So the team really works hard on making sure that we have all of the stuff, the information, but packaged in a way that it's starting to really resonate across a different segment of clients.
That's amazing. We're going to be talking a lot about exactly how you do all of that at Dimensional. But before we dig into that, I suggest we start talking a bit about you and your story. I always like to start with that part when I have guests here in the show. So I know that you pursued a PhD at the University of Chicago Booth School, and now obviously you work in asset management, and obviously you're overlooking billions of assets. So can you maybe walk us through that journey from academia and into asset management and what motivated the transition?
Yeah, sure. So it actually started at Chicago. So can't wait to be at the CFA event in Chicago. I love Chicago. Spent 5 years of my life there, and there I was, as you mentioned, I was working under some of the greatest minds of finance, including Professor Fama. And what I found was through the very painful process of trying to get through my dissertation, I just didn't feel like academic research
Mhm.
was right for me. It felt a little bit too solitary. And I get energy talking about these concepts to other people. So it was actually while I was finishing up the PhD, I went to my advisors, of which Fama was one, and he connected me to Dimensional. So I moved down to Austin, been at Dimensional for my entire postgraduate career
Wow.
because yeah, I mean, it was just the right transition because I had, trained and learned all of the really deep asset pricing and just kind of like that Chicago perspective on investing, really influenced by a lot of the research from Gene. And that perspective on markets, I think, is very unique, two dimensional. You don't really see it in very many asset management places, if you on Wall Street or other places. So this idea of I wasn't ready to completely jump ship off of research. And joining the research team at Dimensional was kind of this perfect in between because we take our research very seriously. It still has all of that academic rigor. We're really building on the ideas of these giants. But to see it come to life, and more importantly for me, especially where my role has taken me, getting those ideas to people where it can actually change their investment outcomes, how they think about investing, how they think about like getting to the best investment experience they can have. That to me is really what's rewarding for me. And that's something that I've really been able to find at Dimensional.
That's awesome, and I love seeing that you've done all your professional career in the same place. That's so rare nowadays. So it truly means that you must love what you're doing and the colleagues and the culture over there. That's pretty cool. Um, so I'm sorry because I'm sure you get this question like 1,000 times a day, but obviously I think you're the first person I know that worked so closely with Gene Fama. I mean, obviously, I think all of the listeners to the podcast. Of this podcast know who he is. He's considered one of the fathers of modern finance because of his work on the efficient market hypothesis that transformed the way we think about investing, and he even earned a Nobel Prize because of that work, I believe. So for many, he's like a theoretical giant, but for you, he was your professor, your mentor, your advisor. You just said, and you were his teaching assistant. what was it like studying under Eugene Fama and working alongside him on all this research?
I mean, back then it was pretty intimidating. um, he's just such a master of making some ideas that are so complex and simplifying it down to its kind of core tenets and the importance, especially in language, of
Hmm.
that. To me, was something that I really took appreciation for when I was taking his class of kind of like what you may have a very complex idea, but you really need to have a simplifying framework in order to clarify what assumptions you're making, what are ways to test a hypothesis. And I think it's really an art form to do that. And then when I became his teaching assistant, I had a much better appreciation for all of this because as I'm correcting the exams, you can tell based on how many words people use to answer a question how well they actually understand it. A perfectly crafted answer to a lot of these questions would be one sentence, and we'd have students that write half a page.
Hmm.
And I think that that's actually really telling of how well, if you can distill it down to its just essential components,
Yeah.
whether it's an academic idea or for that matter, like a lot of things in life, in order to teach it to someone, that really requires just such a deeper understanding. And just precision in language and precision in thought is
Hmm.
something that I've never seen anyone quite master it like Gene.
Wow.
So it was a fantastic experience. I bring a lot of those lessons to me every day. We create content, and the goal is to try, how do we get to the most compelling argument, and how can we make that in the shortest but still the most compelling way possible. That's an art. It's not that easy to do.
No, 100%. Particularly not in finance, where we have this tendency to overcomplicate things. So, would you say that's your main learning from your peer over there? The realization of the importance to of being able to simplify complex terms and explain them in plain vanilla words and really going straight to the point.
Yeah, absolutely. Being straight to the point, being able to connect um, just the flow of an argument. So I was always, there's one thing that Gene said, and this is when he was teaching his first year PhD course. And we're going through, in my opinion, a lot of complex research. But he was talking about some of those very early but completely industry changing papers. So whether it was the cross section of expected returns paper, the 1992, the 1993 papers, he said he didn't think that those papers were all that groundbreaking or revolutionary. And basically, what they did was gather up a whole bunch of disparate findings and put them together in a way that people could just see it. Like it just hit them over the head so that they
Mm.
couldn't ignore it anymore. So he always described some of those successes as half marketing, half research. And coming from Gene, I don't know, he just doesn't really strike me as a marketer. I don't know. It's something that I've always carried with me.
Wow. Yeah, me, I wouldn't have thought about him neither that way. For me, he's like the quintessential finance nerd. I mean, if you
Yeah.
build a model that shapes the whole finance industry, you have to, you have to have that title. But it's interesting what you're saying, because something I noticed while I was doing research for this episode and seeing the other interviews you've done is that you have like a very unique profile. You have a very technical profile on one side, but you're an excellent communicator on the other. And obviously, it's not easy to come by profiles like yours. Um, so my question for you is, how do you approach translating all these complex, deep academic insights into something real and useful for advisors in such a clear way? And what role does storytelling play in all of this?
Yeah, I think that storytelling plays a really important role. So when I think about just how do I go about crafting a story, the first thing, and this is where the technical background I think helps, is for me, it's really important to first understand what do the data say? And I can't craft a story until I know what the data say. I want to really be able to understand what are the things that I can't infer from it. What are the things I can? Have I thought about correlation versus causation? Have I thought about like magnitudes of like, is this actually something important? And once I feel like I have a pretty good handle of what actually is happening, then I need to figure out, okay, well, what is it that's important to the audience? Like what messages will resonate? And then thinking about like, data visualizations or how to package it comes last. I often see people make the mistake of trying to do that in reverse order of how do I make a pretty chart? Like, no, 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 you have to start with what do you want to say? It seems obvious, but I see it time and time again where it's okay, well, let's look at this data visualization. It's so cool. Like, yeah, but it's just a lot of information. I'm not sure what I'm supposed to take away from it. It's actually really important to think what is it that you want to take away before I can even decide should it be a line chart or should it be a bar chart or whatever it is. But that I think is the most important, probably. The harder thing to do is figure out what message does your audience need to hear and how can you best deliver it to them? And that's going to be different also for different audiences. So there's an element here of, I would say, it's almost empathy or like there's some level of human connection to, and this is why I think it's actually really important that for me personally, I meet with clients all the time. So really understanding what is the question behind the question, what is the goal that they are trying to reach that they can't communicate, and trying to orient the information to really get to a place where it's answering the underlying concern or the underlying goal that they might not even know that they have. So it's a little bit of an art
Yeah, 100%.
associated with marrying the data work.
I love that part of answering the question behind the question, like trying sometimes to figure out things that maybe the clients even haven't realized themselves. And I guess that comes with experience, right? There's no other way of putting it. Um,
Absolutely.
so it seems like from the research I've done about you and your work that curiosity has always been pretty central to your work, from obviously researching how markets work to helping people make better investment decisions. Where does that huge intellectual curiosity, particularly for financial markets, come from, and how do you keep it alive over time?
Yeah, I was trying to think about this because I think in order to be curious, you first have to be humble, and you have to realize that you don't know anything, and like know everything, and that just about everyone you come in contact with, they've lived a different life, they have a different perspective. There's probably something you can learn from them. And I think that that's one of the things that have caused me to stay at Dimensional. Is just there's always stuff to learn. So it doesn't need to be entirely self-driven in my case because there's just so many opportunities to learn from someone else.
Mhm.
But what it really does take is just like knowing that I don't need to be the one to show someone, here's all of the information I know. It's a much more rewarding conversation for me if I can get someone talking about something that they're interested, they're working on, they're passionate about, and then just keep pulling on that thread. And eventually I'll learn something new from them.
Mhm.
So it's a little bit of that humility. It's a little bit of just, I find connections with people rewarding, and learning about them is part of it.
Mhm.
And that also leads to opportunities to learn new stuff.
Yeah, I think everyone has something to teach us. A lot of times I meet people that tell me, "Oh, but I'm not interested." I'm like, "Are you kidding? I mean, you have so many things to share, and so many things I'd love to learn about. And a lot of times it's just to putting them in the right framework, state of mind to be able to share that that knowledge and soak it in. So I completely relate to what you're saying, and all of that has to come from obviously a state of mind of humbleness. I wanted to ask you, actually, before I ask you that, I wanted to ask you something else, which is, what did you write your PhD about? Because I think we haven't talked about this yet. What was the theme of your thesis?
Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Nacho, you're the first person to ask me that, I think.
Ever.
Ever. In at least the last decade. Because it wasn't really that relevant to what I do today. Earlier I was talking about correlation versus causation. So
Yeah.
my dissertation was on, very boring, housing wealth effects.
Okay.
So at that point in time, so I graduated in 2008. So a lot of my
Great year.
PhD was during, yes, not yes. All of the sarcasm. But yes, most of my PhD dissertation phase was written during a time when the housing market was just going bananas. And at the time, Fed models, economic prediction models, try and figure out, well, what's the wealth effect? So if your house goes up by, $1,000, does that make you feel richer, and how much more will you spend?
Mhm.
And at the time, a lot of the estimates were about 3 to 6 cents on the dollar. And what I kind of thought that was more of a correlation than a causation. So I showed that by comparing renters and homeowners. So renters, if they live in an area with rising house prices, they also tend to consume more. But very clearly, it cannot be because they feel richer.
Wow.
So
I love it. It's super interesting, honestly.
Oh, thanks. I don't
No,
use it today.
no, but with everything happening in markets today, I'm sure there's a couple of things in that thesis that we could that we could use to explain some of the things happening in markets nowadays.
I do think this idea of correlation versus causation is super important.
Yeah.
And always having that frame of mind of trying to understand ways to tease that out, that's always relevant.
Yeah, I'm very active on social media. I follow a lot of finance creators, and I think my most common comment out there is correlation doesn't imply causality, because so many times we tend to make that mistake. I think we're pretty good at finding correlations in and patterns across different data sets and things like that, but obviously one thing doesn't necessarily explain the other.
We're wired to see those correlations, and we're also, because this is about storytelling, we're also very good at telling stories to make it seem like correlation could potentially be causation. And the reason why it's so important to disentangle the two is, if it's not causation, there's not really a great reason that you should expect it on a go forward. So
That's
very important.
Yeah. And I think it also has to do a lot with the fact that we as humans need to find explanations for everything,
Hmm.
which is the beauty and the curse of the finance profession, I guess, because sometimes you can find pretty neat explanations and logical explanations to what's happening around us, but sometimes we make some weird stuff up that doesn't make any sense. And differentiating between the two is really really important, especially when you're talking about managing people's money. So let's talk about dimensional now a little bit, because yeah, I think what you guys are doing is pretty interesting. So you are known for applying very rigorous academic research, especially insights from Gene and Ken French, I believe, to real world investing. And I think that blend of theory and execution to that extreme is rare in the industry. So in practice, what does it mean to translate all this academic research into portfolio construction, and how does that show up in the way you folks are building strategies?
Yeah, well, how much time do you have?
As long as you
Because
need.
it because I would say a lot of the insights that we use to build, to manage, to execute these portfolios, it does come from academic research.
Mhm.
But the an academic paper, I think, would only get you about 10% of the way.
Okay.
You really actually have to, like for us, and we have a very deep internal research team where really understanding what the implications are of a particular research paper takes a lot more vetting, right? So you need to first make sure you're not chasing something that's data mined. You need to make sure that it's something that you can actually implement in a real world portfolio, right?
Mhm.
Because paper profits in a simulation is not the same thing as managing money to it. You have to make sure that something you're looking at is additive, right? It's not just a recreation of something that you're already pursuing. Um, and all of those things, like there's different techniques that you can do to resolve all of those concerns, but that takes a lot of additional research beyond what you might just read about in that initial publication. Um, and I think that once you get past some of those things and you think, yeah, this is real, this has the potential to be additive, then you really need to understand, well, how am I actually going to implement it? Because something like a value or profitability factor, right? Or
Yeah.
premium, those behave very differently than, say, a price momentum. Or, so this is getting a little bit in the weeds, but one, you can put into a portfolio and not result in a lot of turnover, and one results in a lot of trading and a lot of churn. So you have to also just understand how these premiums behave in markets in order to start constructing a portfolio where you're thinking about how these premiums interact with each other, how they would im- uh, how they would impact things like turnover, which is super important because in the end, turnover means costs potentially, and so if the premium isn't big enough to offset any kind of additional cost, then it wasn't worth it.
Mm.
So there's basically a lot. There's a lot of additional work to translate these into something that you can actually use to confidently add value in terms of net of trading costs or just net return.
So you were talking about factors like value and profitability. How do you decide which factors matter and when they should be emphasized more or less? I mean, obviously, I guess there's a part of this that you cannot disclose, but yeah, how do you do this? Because it looks like rocket science to me.
Well, you have to. I think that there's a few things. So the major ones that I think an advisor or someone who's putting together an overall portfolio can really pay attention to are, in our view, would be size. So
Mhm.
smaller companies tend to have higher returns than larger. Value, so lower priced
Mhm.
companies versus higher priced, and then profitability. So more profitable companies tend to have higher returns than profitable ones. And there's really good reasons why you should expect that to be the case. And then on top of those reasons, then you also have data from all around the world spanning decades that support this. So I would say the first thing you have to do is how confident are you
Mhm.
in any given factor? So those are three that we're pretty confident in. The second is, are you confident that you can pursue them after costs? So those three you can run in portfolios with very low turnover. So we have, things that are like market-wide portfolios with kind of high single-digit annual turnover. So very, very low index-like turnover pursuing those types of factors. Um, and then how do they like play with each other, augment each other? So for example, profitability is a very good complement for value. Pursuing both of those simultaneously helps you get to basically a smoother ride, helps you pursue outperformance with lower tracking error. So those are all good things. How does size fit into the mix? Well, we know that a lot of these premiums tend to show up more in small caps. So paying attention to how you're kind of pushing on all of these different dimensions in a portfolio all simultaneously is kind of the art. In our mind, how do you push on, or how do you determine what's the most important one? From our perspective, all three of those are important. And there is a trade-off though of, we often have clients ask, okay, well, how much of each do I put in? I would say you probably want all three, but I can't tell you if you want a light dose of them or a really heavy dose, because in the end, that goes to how tolerant are you to looking different from the market, to having the potential to underperform the market in periods where those premiums are not showing up. And then, of course, there's a lot of other things. So those are, I would say, the three main ones. And then I just mentioned things like price momentum. There's reversals. So price momentum is the tendency for a stock that has been doing relatively well to continue to do relatively well in the next 6 to 12 months. Reversals is basically the opposite, but on a much shorter term frequency. So, over the next day or week, something that has done really well tends to underperform. So those now we're talking, instead of having portfolios that can have, let's just say, anywhere between 10 to 30% turnover to pursue, now we're talking about portfolios in simulations, they can have, multiple hundreds % return. It's a very different type of of information about expected returns that decays really quickly. So how you use that needs to be different if you don't want to have a portfolio that's going to turn over a lot. So I would say that there's a lot of different, whether you want to call them factors or conventions, premiums, whatever it is, you want to make sure that first you believe it, that it's not just something that's data mined. For that, you want to look at all of the data you can get. We have far more confidence in something that usually gets found first in the US, and then you want to take it to markets outside of the US. Do you see the same thing? If yes, that gives us confidence. Okay, it wasn't just something that we data mined out of the US data. Is there a good reason to expect it? That's, just like we were saying, causation versus correlation. If there's a mechanism that helps you give you more confidence that this is a causal relationship, then it's something that you should expect to continue in the future. So those kinds of things, I think, are all really important to everything we put into the portfolios. And then you also want to be pretty flexible in thinking and being smart about how you actually apply it. So whether we're going to tilt a portfolio, so in other words, overweight certain stocks versus the market, that's one mechanism. For things that are very high turnover, we may just say, well, let's actually slow down the turnover and say, rather than buy or sell something today, I'm going to wait a little bit. So how that looks is, let's just say I have a portfolio that wants to sell something, but it also has up momentum. Up momentum tells me, well, it's going to continue to outperform for a few months. Then maybe I just want to let that momentum kind of peter out. I'll basically hold back my turnover, wait to sell it as opposed to selling it today. Just as an example of how there's lots of different ways you can express the information that we find in academic research, depending on how it behaves in markets. Another thing that we might do is we just exclude certain things from the portfolios. So there are segments of, for example, the small cap market, which just have such poor returns. We can completely exclude those if we think it's not going to be that detrimental to diversification. So having like a lot of different ways to implement these different research findings is part of the art. And what I see often in other approaches that may try to do like a factor-based approach is, okay, let's treat all of the factors the same, right? We have our value factor, momentum factor, and we're going to treat them the same. That doesn't really reflect the nuance that you see in how these premiums behave.
Wow. I feel I just had an MBA about factor investing in like 5 minutes. Thanks for that. I'm going to be re-listening to that section and taking a bunch of notes. But thanks for the color. Yeah, it's super interesting. And you were talking about implementation a moment ago. I know that you've emphasized implementation as a source of edge in the past, how trades are executed, how taxes are managed, how portfolios adjust in real time. Can the implementation ever be as important as the investment strategy itself, you think?
Oh, I think the two they go hand in hand. Absolutely hand in hand. So there, in the end, a lot of like the premiums will drive kind of the high level returns. But let's just say we're looking at, there's a whole Morningstar category, for example, of value funds, a whole category of small cap funds. Yet within each of those categories, you still see a lot of return dispersion. So that's where I think different managers, different portfolios will have different ways of pursuing those premiums. Will certainly have different ways of implementing it. Even if you look at like the most plain vanilla examples, like let's just say I want to look at just overall market portfolios. Like think very plain vanilla, no factor tilts, none of those things. And I take index funds that track those. You still see tracking differences across just plain vanilla indices. Of course, like you're going to see a lot more if you're looking at small cap indices, but so there is basically a lot of potential dispersion in returns, just because returns are so noisy. But then what we do find are things like if you have more turnover, those portfolios are less likely to outperform their benchmarks. Why? Probably because they have higher trading costs. So I do think it's one of those things that it's important to pay attention to, I think, every part of the investment process. Understanding what premiums or factors one wants to pursue is definitely important, but then how they pursue it, is there flexibility in the process so you're not losing returns at the point of the trade? That's where I think index funds potentially kind of fall, and where I would absolutely recommend any listeners or investors that you have to pay attention to more than just the like headline expense ratio, right? Those keep coming down. You can get a index fund for very cheap, but you have to ask yourself, what are the additional costs associated with that you don't get to see in that expense ratio? And I would say a primary one would be trading costs. Or if they're rebalancing infrequently, did they miss out on some of the premiums because they only look, once or 4 times a year, and think about rebalancing their portfolio so that you might have some style drift and some opportunity cost associated with that. All of those things result in, I would say, a potential for a lower expected return, but it does take more to evaluate those things.
And something I wanted to ask you about related to all of that is that obviously there's all the theory and what you see in your models and so on, and then you have like real world behavior, which is obviously especially when emotions kick in. And how do you reconcile what you have in your Excel spreadsheets with the messiness of real life investors, advisors, and human behavior and all the biases we're subject to?
It's one of the reasons why we really focus on working with financial professionals. And because I think the answer, it's not a silver bullet, but I think one of the most powerful tools we have to dealing with investor behavior or biases or, letting emotions dictate what happens in their investment portfolios. Like, we want to remove all of that, because what we know is that markets reward investors over the long run. And that I strongly believe that markets do a great job of getting information into prices, so that you should expect a positive expected return every single day, every single moment that the market is open. So if you start with that premise and can get people to stick with their investments for the long run, then they're not going to harm themselves by, getting in the market or out of the market at the worst possible times. And a big part of that is education.
Yeah.
It's setting expectations on this is how markets work, first of all, because if you have that philosophy that the markets are always going to be smarter than any individual investor, then, and this idea that markets will always be priced to reward investors, the combination of those two ideas is super powerful and freeing. It means you don't have to pay attention to what's happening in the headlines and freak out and say, like, I need to get out of my stocks because of all of the market volatility. And then when are you going to get back in? We need to have kind of a philosophy and framework to get us to be that disciplined, long-term investor that doesn't freak out when we see market volatility or freak out when we see negative headlines. So for us, that's education, and also working with financial professionals, because in the end, where does that discipline come from? Or we're not going to, in the end, I know, like, all of the financial research stuff. I know all of this, the studies about, active management doesn't win. And still I sometimes am like, oh gosh, markets are really volatile right now. But having an advisor to kind of help you stay the course is so important. So for us, that layer of having basically a coach, right? It's just like you'd hire a coach to, help you work out at the gym. Like, our financial picture is one of those areas where I think for us at Dimensional, it's really important for us to always remember it's all of those dollars reflect sacrifices. People didn't, they had to save, they had to sacrifice in order to have that money to save. And it reflects a hope or a goal for them in the future. Like, there are very tangible, lives behind all of the assets that we manage. And I think that always remembering that is very important, so that you don't just kind of lapse into it's just numbers, it's just basis points. And I think all of that is always really important to remember and empathize, so that you can kind of have this like foundational ground of like, I get you, I see you, but still you can't let your fear take over. I think all of that's really important.
I think it's pretty cool, these deep partnerships that you've established with advisors, not only as a distribution channel, but as collaborators in, as you were saying, education, and even like the way that you shape your strategy. That's pretty unique, I'd say. And yeah, I think a part of the success of this formula is obviously that a lot of these advisors are professionals and very good investment communicators. So I wanted to ask you a question about that. In your view, what separates great investment communicators from the average ones?
Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Oh, I think having a point of view and a philosophy. So one of and the financial advisors we work with, they're all independent. So they don't have to work with Dimensional. What what we absolutely encourage them to do is it is their job to do due diligence, and to the extent that they determine that we're their best solution, or that we want to be that, but it is our job to continue being kind of on the cutting edge, continuing to push the envelope and get better so that they want to select us. So I think that that's really important. And a part of that is this idea that we don't think we're the smartest out there. We actually think that the market does a fantastic job of pricing news as it comes out. We're kind of seeing the market do a really good job of pricing information as it comes out, right? Like market volatility is part of a well-functioning market. And that, I think if we have that as our cornerstone, from that, you can branch off into how do we communicate to, whether it's helping advisors communicate to their clients or communicating to, investors everywhere, that while the headlines or whatever it is, there's always the economic implications of anything, even though those are still down the road, still unfolding. This idea that markets have already incorporated that and they move first is such an important concept. And I think that any kind of investment communicator that gets that and that embeds that in how they communicate, it's so freeing to have kind of like that touch point that you come back to time and time again. And working with investors and being able to kind of modify whatever you're saying to what they're feeling at that moment, but having that base of an investment message that is consistent, I think actually is really important for any communicator. It's not just the communication. It's how do you work with clients. And when it comes to investing, I think people want peace of mind. And having a story that is not changing, that you're not making excuses about, gosh, I got that investment call wrong and here's, I'm going to do better next time or whatever it is. Instead, to have something that is like a cornerstone, I think is one of the key ways to give peace of mind.
Fun fact, storytelling that you were alluding to is my number one objective for 2025. Getting better at telling stories this year. I think is going to be my priority, because I think it's one of the most underrated skills for finance professionals. One of those things that everyone talks about, but no one really takes it too seriously. Or not many people, and the more I think about it and the more years I spend in the industry, that the more I realize that it's clearly one of the most important things out there. So if you master that, you have very high chances of becoming a better finance professional, in my opinion. I'll let you know how that journey goes.
Good luck, Nacho. It's a good goal.
Yeah. I think it's something that it's gonna take several years, but I think I'm into something. I'll let you know. So I wanna shift now to a completely different topic, which is risk. Obviously, in everyday language, people use risk as a measure of danger or loss, but in finance, obviously the definition is a little bit more nuanced. It can refer to different things. So I wanted to ask you, how do you refine risk at Dimensional in the context of long-term investing, and why do you think that risk is such an important factor?
Yeah, so I'll kind of almost start at the end, which is what should risk be to an investor? And there's some very easy definitions, and I think therefore the easy ones are overused, like volatility. You can calculate volatility very easily. You have a return stream, you pop it into Excel, it's reported everywhere. Volatility probably isn't the best measure of risk for an end client, or at least I would argue that a more relevant measure of risk is, are you on track for your goals? If we're talking about someone who's saving for retirement, I would say the measure of risk is, are you going to run out of money? Can you support the spending level that you want? Are you going to outlive your savings? Like that to me it makes so much more sense as the correct measure of risk, but it's a harder one because there's so many uncertainties there. And sometimes those two things, they can contend against each other, right? Because if I talk about volatility and like I don't want to take any risk and I'm measuring it as volatility, then maybe I put everything in uber safe bonds or CD, T-bills. And that's going to have lower volatility, but it also heightens the risk that you will not meet your investment goals or that you'll run out of money because those are not high expected return assets. The volatile stuff is, right? We know that at least historically, what grows wealth are volatile assets like equities. I think another more financial professional angle on that is all of the boon and privates, right? Like just because you don't see it getting repriced doesn't mean there's not volatility. And are you kind of putting the horse before the cart? No, the cart before the horse. Oh gosh, I'm really bad with idioms, which is really funny. But you know what I mean, where it's I really worry about people who may put things into investment options almost because they can cop out of seeing the risk in it. And that's also, there are two different takes on it, but really identifying how do you define risk and switching the narrative to, even if it's the harder one to measure, how it's worthwhile thinking about. And then it also helps reframe how to put together a portfolio. So let's just use the running out of money example, where if you're sitting down from your advisor and you're kind of nervous because there's a lot of volatility out there right now, right? If you're saying markets are down, what should I do? And your advisor tells you, we've accounted for this. You're still on track for your goals. You still have decades ahead of you. You don't have to worry about it. To me, that reframes the problem so that you can be more disciplined, so that you don't have to freak out because your advisor had already planned for this. And most, I think, financial plans would incorporate lots of volatility in it. So that aspect of how to think about risk, I think, is actually a very important one because it ties in and it marries to how do we communicate investments so that we can encourage discipline and long-term thinking. In terms of how we think about risk at Dimensional, we have to think about it from that point of how do investors think about it. So we have to recognize that it's not just about volatility, that investors also care about, well, like how different do I look from the market? So thinking about things like tracking error. We also have to think about just, I would say, just how do you build a really robust, not frail portfolio? And from our perspective, the number one tool any investor has for that is diversification. Because any given stock, any given sector, any given country, like as soon as you start carving the market up and holding subsets of it, you're adding additional potential uncertainty, I think, as opposed to you can hold the whole market and not have to try and guess where returns are going to come from. And then your premise for why you should get positive expected returns, it's, well, there's always innovation. There's always, I kind of think of markets as like a huge ecosystem with lots of competition and different companies like competing for resources. But in the end, you don't have to pick a winner and loser because the overall market system is fairly resilient. And we've seen it reward investors who can have that broad framework.
I loved how you were talking about volatility in terms of having a plan and kind of sticking to it. It when you were talking about that, it made me think about that quote that I think it's Mike Tyson that said, "Everyone has a plan until you get punched in the face." And I guess, yeah, it's easy to have long-term plans. It sounds reasonable until, downturns kick in and difficult times come in, and that's really, I guess, and coming back to what we're talking about before, having an investment professional by your side that has accounted for this and communicates properly is so important. That's something I wanted to say. And the other thing, coming to the concept of diversification that you were just alluding to. So I think everyone agrees that diversification is an excellent idea, but I think not everyone really always understands it or implements it well. So, in your view, um, where do investors often go wrong when it comes to diversification? Is it the lack of awareness in terms of the kind of exposures they get to, or something completely different?
Such a good question, because I think that the wrong question is how much diversification do I need? Which basically I think frames it as like what's kind of I don't know. To me, it's like, do I need 30 stocks? Do I need 50 stocks? Sometimes people point to, just reduction in volatility and say, like, oh, okay, well, it kind of plateaus after you get to 50 or whatever number of stocks. To me, that's the wrong way of looking at it, but is a very common way. To me, I'd reframe it as, I mean, at this point, you can get access to global markets for not that high of expenses. Like the expenses on building a globally diversified portfolio is so low now. I think the question should be, why shouldn't I have all of the diversification I can get?
Mhm.
It's not, do I need 50? Do I need 100? It's, why shouldn't I have 10,000? And that, I think, is just a reframing of the more, the better. And you might not see it in terms of like, as I add more, the volatility, what happens to that. But what we know is even thinking about the US, right? Like I think a lot of people might think the S&P 500, you have 500 or so number of names, that should be plenty of diversification.
Yeah.
But on the other hand, why wouldn't you want global diversification? It's not always the case, even though the 15 years that we've had recently has kind of made it hard to keep telling this story, because the US has been on such a tear. But if you go to the decade at the start of this century, it was the entirely reversed situation where it was international markets that did a lot better than US markets. So the overall question, I think what's stopping people from diversification is honestly like a FOMO situation of, why do I want it all when these 10 stocks or these Mag 7 stocks are doing so much better?
Mhm.
But on the other hand, there are always going to be a handful of stocks that are beating everything else. That's just the nature of how markets work. There's lots of dispersion. But unless you can identify those in advance, then and lots of stuff says that's really hard to do,
Yeah.
then you want to hold it all.
Yeah, it's funny that you were alluding to the S&P, because that's exactly the example that I had in mind. Like, a lot of people are not aware of the top heaviness of the index. They think they have, equal exposure to 500 names, when in reality, unless they bought the equally weighted version of it, they have a huge exposure to tech. And it's that kind of thing that I feel sometimes is a little bit misunderstood. And again, we always come back to the same thing, why it is so important to have an investment professional by your side. Um, I have a question regarding uncertainty. So, advisors and investment professionals always feel the pressure to forecast the future, but I believe your work suggests that preparation often beats prediction. How should investment teams prepare clients for an uncertain world without overpromising on the precision part?
Yeah, so that's where we like to give, especially the financial professionals we work with, like lots and lots of data, where I actually do think about, there is a, like, returns are noisy. We're seeing this. They have, some years are really great, some years are really bad. It all kind of averages out, at least in the US, over the longest time period to about 10% annualized, but there's a lot of range around returns. And yeah, we don't think that we can predict whether it's going to be a good year or a bad year. As soon as people find out that I work in asset management, they always ask, "Oh, what is the market going to do this year?" My answer is always the same. I always say 10% plus or minus 20, which is actually on the low side in terms of the actual volatility. And they don't seem to ever like that answer. But I think it's a pretty it's basically, I don't have any information that tells me the distribution of returns. What are the potential outcomes that it should be any different than it has been historically? And it has been huge historically. So this is where this aspect of working with a financial professional and understanding that range of outcomes, that markets, bear markets, down markets, they will happen. And they have happened, and you can plan for that, right? Like you can, if you have a long enough holding period, then you can modify how much you spend or save. You can there's different ways that you can plan and prepare so that you're not drawing from a pile of your pool of assets that are invested in really volatile things if you need it next year. So I think that giving some understanding that these things can happen, they will happen, like down markets will happen. We've prepared for it. Your financial plan can survive market downturn. And if things look, really bad relative to what we prepared, then we can modify course. I actually think that that's also really important to work with an advisor, because financial plans shouldn't be set and forget, right? It should be, we can make plans knowing the range and potential outcomes, but as we progress through our lives and through time, those kind of expectations all of a sudden become realized, right? So at some point, we don't need to guess what next year's return is. The year will be past us and we will have known, and we can update our plan. So that process of updating the plan, where it's, hey, if things get tough for longer, then maybe we need to save more, or maybe we need to cut back on spending. Those are the things that are under our control. The things that aren't under our control is market movements. So I think we should actually give up trying to, we definitely can't control markets. I've not seen great evidence that anyone can really predict them in a useful way. So the only thing we can really do is plan for it.
I love it. Yeah, 100%. No one can predict it for sure. Otherwise, they would have their own hedge fund and would be probably a billionaire by now. And the only thing that most of us can do really is, plan and prepare and trying to stick to the plan in the difficult times. So as we get close to the end of the interview, maybe a couple of last questions regarding the future. Where do you see things going? So regarding financial advice, obviously, we've seen tons of progress as of late, better tools, obviously the arrival of artificial intelligence that is shaking things up quite a lot. Are you optimistic about the future of the finance industry and of finance professionals specifically? Do you think we're all going to lose our jobs in a couple of years, or are we still going to be here 5, 10, 15 years down the road?
Gosh, I hope we're not all going to lose our job. But I'm absolutely optimistic. And there's a few reasons for that. So first, we are seeing a shift in the industry from what I would say kind of more traditional pools of assets into more of the wealth space, right? Like a lot of workplaces don't provide pensions anymore. And individuals are, we're taking on more and more responsibility for our own retirement planning, our own savings. And that's that shift, I think, requires the industry to recognize that there are going to be a lot more individuals that need help, that need assistance in this, and that the industry has some stepping up to do in terms of how do we get kind of scalable but still personalized advice. And there's lots of, different tools. You mentioned AI, things like that. I think that that's an interesting area to kind of watch. I talked to a lot of different advisors, and it always seems like the tooling is an area that can use improvement. So let's hope that we can have more scalability in terms of the tools, so that advisors can spend the time where it's most needed. And I would say that's in front of a client. It's communicating with clients. It's and I would say it's also shifting what is their role, and recognizing. I think more people need to recognize that the role really needs to be a little bit part therapist, part understanding people and what they want to do with that money, and being able to put together portfolios that first make sense for what they need, and then getting them to stick with it through good times and bad, and really only modifying when their personal situation, their personal goals change. So, I really look forward to seeing that type of model of financial advice, where it's really focused on the individual and getting them to their goals, as opposed to, I'm going to tinker with your asset allocation and tactically time things. Like, I don't think that that's really where the value of advice is. So look forward to seeing a lot of the industry of advice kind of shift in that direction, and for more people to realize that they can benefit from having a financial advisor.
I love the optimism. I'm with you. I think the best years are ahead. And a lot of our listeners are CFA candidates. A lot of young people looking to enter the industry in the upcoming years. What would your advice be in terms of which skills or mindset to develop to be relevant in the finance industry tomorrow?
Gosh, it's a very good question. Here's what I've experienced, which is, I was listening to a podcast recently, and it had kind of this term "fail forward," which I loved, because I think that throughout my, whether it be education or career, as opportunities have come up, even though they may not feel like the right fit for me, I basically always took them, even if I, was worried I wasn't going to do a good job or any of these things. And, if I failed, then it was still a learning opportunity. So this is a long-winded way to say, I think having a very balanced, both like education, experience, there's benefits to having multiple perspectives, and to being able to see common threads across different silos. And that's something that I think is genuinely human, and I hope that it would be harder for AI to replace those types of functions. But that's where I would just tell people, just be open-minded, and kind of lean into a lot of different directions, because you never know which one is going to lead you down the long-term career path of success.
So stay curious and have an open mindset. I really like that. I think it's definitely a good tip. Marlena, it's been amazing. You've shared so many insights today. For those of them that, for those listeners that want to stay in the loop with what you're working on, that want to follow your research, your writing, your speaking, what's the best place to keep up with you and everything you produce?
I basically quit all social platforms. So to follow my work, which is mostly the team's work, I would suggest folks follow the Dimensional corporate account on YouTube, on LinkedIn, and you'll see a lot of the stuff that I'm doing or the team is doing through there.
Fantastic. So we'll make sure to have a look at that. Marlena, thank you so much for coming to the show. It's been an absolute pleasure. I really, really look forward to meeting you in Chicago. And I wish you a happy trading year. Despite all the market volatility, I hope that you manage to make the most out of it. And that 2025 is the year where you bring Dimensional to new heights.
Sounds great. It's good to meet you, Nacho. See you in Chicago.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.